Thanks for joining us for episode 1 of our transition series. In today's episode, we'll be discussing how to identify your lease portfolio. With me today is Sarah O'Sullivan, Director of Product at Lease Query. Hi, Sarah.
Hey, Emily.
So, how does someone know if they have a lease? What should they look for?
Yeah, so leases are obviously our big topic right now with ASC 842, and it's really critical that you identify all of them up front. Obviously, with 842, we're bringing most of our operating leases onto the balance sheet for the first time. And so that means that they have a direct financial statement impact now. And so if we don't find all of our leases, then we risk having a material misstatement on the balance sheet and impacting our financial statements. So yeah, what exactly is a lease? Well, the technical definition from 842, it states that it's a contract or a part of a contract that conveys the right to control the use of identified property, plant, or equipment for a period of time in exchange for consideration. And so we're pretty familiar with that concept. We've been accounting for leases for a long time and looking at them and reading through them. But a couple of the things that I think are important to highlight now that the greater scrutiny they have is that a contract can contain a lease, even if it doesn't read like the lease that you're used to or specific lease wording or be labeled a lease. I know you mentioned before that when you were implementing 842 at your previous company, you really retrained your organization to start using the term contract rather than the term lease. And I think that's a really great tactic and a good best practice to kind of throw out there, because it really emphasizes the fact that, especially when we start talking about embedded leases, we'll get into a little more detail in a second, but you need to be careful when you're reviewing these contracts because it may not say lease, but it may really be a lease. And so again, we're familiar with the basic concept. What is a lease? What is the definition? It's paying a third party for the right to use an asset that party owns that we don't own. We're going to use it for a period of time. And so ASC 842 doesn't really change that basic concept, but there are a couple of things that it emphasizes that weren't as big of a thing under ASC 842, 840s that we should look at. So the first concept is this idea of substantive substitution rights. And if a supplier has substantive substitution rights, if this exists, then the customer doesn't actually have the right to use that asset, an identified asset. And so that contract doesn't meet the definition of a lease. So in order for the supplier to have that substantive substitution rights, there's two criteria that have to be met. They have to have the practical ability to substitute an alternative asset, and they need to be able to do that throughout the period that the customer is using it. And then the supplier also needs to be able to benefit economically by exercising that right. So this means, they're going to benefit more so than whatever cost it takes to move those assets around or replace that asset. I think an example we could talk through would be something like a photocopier. Typically, these are, generally smaller in size, and your vendors that you're leasing these kind of equipment from, they're going to have an inventory of these that they can go back to and pick one out and replace it if they need to and shuffle around. So that may be a situation that you are looking at where you as the customer don't actually have the right to a specifically identified asset.
Right. But like your landlord isn't going to ask you to move office spaces.
Right. So another concept we would want to talk about is this idea of control. ASC 842 places a greater emphasis on control than what we've seen in the past. And they actually put this word directly in their definition of a lease. And so the customer is considered to have control of the asset if they have the rights to obtain substantially all of the economic benefits from that asset, and they can direct the use of the asset. So under legacy rules, the primary focus here was that economic benefit criteria. It didn't talk so much about the directing the use of that asset. And so that's why we mentioned, and that's why we're kind of an accounting community talking about there being a greater emphasis on control now. But this is where judgment is going to come into play as well, because the standard, it doesn't give you a specific definition or criteria for what substantially all means. It doesn't provide us with a all-inclusive checklist that we can follow to make sure that we're coming to the right conclusion. You've really got to think through some of this. And so some of the factors you might want to be thinking about is, what is the purpose of that asset? Does the customer actually have the right to direct the use of the asset? They can say when it's used, how it's used, where it's used, And so often a lease arrangement is pretty clear cut usually, but these are a couple of the judgment areas that we need to think about a little bit more carefully now under 842. And it really pops up when we start to talk about embedded leases.
Yeah. So one resource I wanted to point out, I know when I was reviewing contracts, trying to, identify our complete lease population, one of the things I looked at was EY's FRED, or their financial reporting developments, I think is what it's called, but it's commonly referred to as the FRED. It's just their publication that they put out. On page 6, there's actually a flow chart that has the specific requirements that a contract has to meet to be qualified as a lease. And I made a checklist out of those requirements. And as I was reviewing the leases, I literally would mark off, yes, this meets this criteria based on this, or no, it doesn't meet this criteria based on this. And then that was my, work paper, my substantive documentation for our auditors. So again, EY FRED page 6 has a nice little flow chart that you could turn into a checklist when reviewing your contracts. All right, so moving on from that, you mentioned embedded leases. The guidance talks about embedded leases, and that's kind of a a nefarious term, I guess, but what exactly is an embedded lease, and how do I know if I have one?
Yep. So embedded lease is definitely a buzzword these days, especially with 842. They're getting a lot more scrutiny. And essentially, really simple way to think of an embedded lease is it's a contract that is not necessarily the primary business transaction is to lease an asset, but because of the arrangements that are agreed to between the parties in this contract, there is actually some sort of underlying asset that the customer is going to gain the right to control as part of the overall arrangement. And so it's kind of like your lease is hidden within a contract that does not say lease. And so supplier agreements are a really good place to look for these, where there's some kind of embedded in there that you don't think of. It's not shouting lease at you right away. Because these might be, customer didn't enter into this contract with their supplier specifically to lease the equipment. They entered into it for, whatever their manufacturing process or the goods or services they needed to receive from their vendors. But they actually ended up with an arrangement that includes an underlying asset that meets the definition of control and direct use of asset under 842. Yeah. So Emily, I think you maybe had an example of like personal experience where this might come up, where you might want to think about it a little bit more closely.
Yeah, an example of one we really had to think through was, we had an arrangement, a contract with a supplier. I guess, let me back up. We had a machine that could construct a corrugated cardboard box to fit any item that we sold, any merchandise. And we had a contract with our supplier to only purchase our corrugated cardboard through them. Well, in return, to process this corrugated cardboard, they gave us this machine that could fashion the cardboard into these boxes. Well, in return for that cardboard, we had this machine. And so did this machine now qualify as a leased asset? And that was something that we really had to think through.
Yeah. And I mean, that's a great example. And it is one of those things that doesn't pop out to you as lease, and it may not even end up being a lease, but it is something that, needs to be thought through here. And you got to weigh that against you got to use some judgment, some cost benefit analysis here, some materiality. You don't need to go super crazy with these. I think both you and I would say in our experience, we didn't come across a lot of, these hidden embedded leases that were suddenly we needed to account for that we didn't know of before. But it's good to really, train your organization to know what to look out for, have a process that's robust enough so that if you did have something material come through as an embedded lease, you're capturing that. And, these type of leases, embedded leases, they aren't new. So they existed, they've been around for a while. Technically under ASC 840, we were supposed to be identifying them and noticing them when they came through. But obviously in the past, since operating leases were off balance sheet, you could kind of get away a little bit. It didn't have the direct financial statement impact that it potentially could have now.
Well, thanks so much, Sarah. And we hope you've enjoyed today's episode and found it helpful. As a reminder, we have many other episodes in this transition series to help you simplify complex accounting. In our next episode, we'll discuss how to find leases that you don't know about and how to classify your leases as operating or finance.